welcome to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches and around Australia on the Community Radio Network, compliments of the Community Broadcasting Association of Australia. I know it's a mouthful, but it's a really big network of 450 plus odd community radio stations that are out there, mainly volunteer organisations, and we get picked up by about 15, 16 different stations, primarily regional. So thank you to those that are listening to us outside of the city areas. We really appreciate your attendance, and hopefully we're bringing some value to you as well. We're also on YouTube, iHeartRadio, and one of the avenues that we also go out to the market is through the Institute of Financial Professionals Australia. And we have a regular contributor, Natasha Panagis, who is a superannuation expert. And she's here today. We're going to be talking a little bit more about superannuation and contributions. But IFPA is also another area where tax agents get their education, and these shows actually form part of that education process and keeping them up to date. So ladies and gents, what you're listening to, the professionals listen to as well, which is really, really good. So what are we talking about this week? We are talking about concessional contributions. Now, Natasha, you've been on the show many times before, and we've talked about a whole range of different things around contributions, concessional, non-concessionals. And so I think the best place to start is, can we just go back to first principles and maybe explain to the audience what the difference between concessional and non-concessional contributions are?
Yeah, sure, Ray. Thanks for having me back on again.
Always great to have you on the show.
Oh, thank you. So look, superannuation, it's a great way to save for retirement, and there's a number of ways you can do that. But the government sets some strict limits on how much you can contribute to super, and these are called your contribution caps. If you go over them, you can face some extra tax, but don't panic there. There is, things that we're going to go through today to help you follow the steps if that happens. But going to basics, there are two caps in place. There's the concessional contributions. These are the contributions that you make to super before tax. So these are things like your employer super guarantee payments, so the 12% that you receive from your employer that goes into your super. It also includes other contributions like salary sacrifice contributions and any other personal contributions you put into super that you claim a tax deduction for. So they're your concessional contributions. There's a cap in place. That cap is $30,000 per year. So that's the most that you can put into super for concessional contributions. That said, there's something called a carry forward concessional contribution rule, which allows certain individuals who have a total super balance of less than $500,000 at the previous 30 June to be able to use any unused concessional contributions amounts that they have over the last 5 financial years, which means that you could potentially make more than $30,000 in one financial year if you meet those requirements. So that's your concessionals. You've also got non-concessional contributions. These are contributions you put into super from your after-tax money. So it could be money that you've got sitting in the bank account, and you can put those contributions into your fund and you don't claim a tax deduction for them. Again, there's a cap on that. It's $120,000 per year, or you could potentially put up to $360,000 if you use something called the bring forward rule. And again, that's available to people who are under the age of 75 and have super balances below particular thresholds. So after tax.
So yeah, that's the big difference that we're talking about then. Pre-tax, so untaxed money. So that's the money that gets sent to you by your employers and various things that you've highlighted. And then after-tax money is money you've already paid tax on, and you're then throwing that into super, and that's called a non-concessional.
Correct. And because it's already been taxed, when it goes into your fund, it goes in as a tax-free component. So, there's no further tax on it because it wouldn't make sense to tax it again.
Oh, well, again, we thankfully have a non-double taxation regime these days. I guess when we're talking about concessional contributions and caps, so it used to be 25,000 and they get incremented as our pay salaries go up and the tax scales change. So that concessional contribution each year now is capped at 30,000, isn't that? That's correct, right?
Correct. That's the amount for everyone. So it's $30,000 per year. But as I mentioned, you could potentially put in more than that if your total super balance was less than $500,000 at the previous 30 June. You have got some unused concessional contribution amounts from the last 5 years. And if that, applies to you, you could do potentially more than $30,000. It could be, 30, 40, 50, potentially even $100,000, depending on how much of your unused concessionals you have. You can check that in MyGov under the ATO portal. And if you have a look at your super and have a look at carry forward concessional contributions, you can see what you've got there available to you. So that could be an option to consider.
So this is very useful, I guess, for those of us that are encroaching retirement or starting to think about planning. That last 10 to 15 years, I've often read by many advisors and many pundits in the industry, that's when your big acceleration in your superannuation balance occurs. And so I guess people that are sort of 45, 50, 55 really can be looking at these areas where they can be topping up and starting to think about really supercharging their super. This is a good way of doing that, I guess.
Yeah, look, and some people might have assets, obviously outside of super. They could have shares, they could have property. They might be wanting to, sell these things off. And if they do and they make a capital gain, then they can put those proceeds into super, potentially as a concessional contribution, and potentially reduce their capital gains tax liability if they've got one by putting that money into super, if they do it as a personal deductible contribution. But again, there's some, eligibility rules there, and really important to speak to your accountant to see if that would, and your financial advisor to see if that would suit your circumstances.
But again, you've mentioned MyGov, and I think it's really important to highlight to people that if you're not sure about what's sitting in your superannuation, MyGov actually has that data, doesn't it?
It does. It's really handy. It tells you what your concessional contribution history looks like and your non-concessional contribution. It tells you if you can use this carry forward concessional contribution rule where you can do up to 5 years in the one go. It also tells you if you can use the bring forward rule, how much of that are you in one, can you do one? So it's very handy. If you haven't had a look at it, it's worthwhile just logging in, going to ATO and going to super, and you can see all of that information there.
Now, one of the things that we're talking about in today's show is what happens if you either on purpose or accidentally exceed this cap. Now, what's the first thing? How do people find out that this has actually occurred?
Yeah, look, when if you exceed the cap, the ATO is going to send you an assessment notice to say, look, this was your cap, this is what you exceeded it by, you've got some options. So that's how you'll know. Typically, the ATO is going to send you a letter. And so if we're talking about concessional contributions today, if you exceed that $30,000 cap, then what will happen is any excess amount over that will get added to your taxable income, and you're going to have to pay tax on that at your normal marginal tax rate. But you will get a 15% tax offset because your super fund has already paid tax on that money, because when it went in, it was taxed at 15%. And if you obviously exceeded the cap, that you're going to get that 15% tax offset because your fund has already taken that 15% tax out of that amount that went in. So, you've exceeded the cap, the ATO has told you, and in that same letter, it's going to give you two options. So you're going to have two options if you exceed the cap, the concessional cap. Option one is you withdraw up to 85% of that money from your super account to cover that tax liability. So that's your first option. Or option two is you leave it in your fund and you pay that extra tax from your own pocket. Now, keep in mind, if you leave it in your fund, that extra amount is also going to count towards your non-concessional contribution limit. Right?
Okay, so I just want to park you there for a moment, Natasha, because we're going to talk about that in the second half of the show, the options that are available. But one of the things that I've been reading the notes that you sent through to me, and great notes, and by the way, ladies and gents, this will form part of an article that will be on the FBA website either now or in the very, very near future. But one of the things that's important to understand is that when the ATO makes these determinations, it's not sort of an urgency kind of thing. You do have a fair bit of time to work through, if this cap has been exceeded. It's not something that, it's not like a parking fine where you've got 7 days to pay or the cops sort of turn up and bash your door down. This is always in the, to use an old Humphrey Appleby thing from Yes Minister, it's in the fullness of time, I guess, isn't it?
It is, yeah. Look, you do have time to do that. At the end of the day, the ATO is going to calculate how much tax you owe. So there's no guesswork on your part, right? So you'll be told, and there's time limits involved in order to make that option and pick your option. But if you think that, there are some special circumstances that apply to your situation that caused you to exceed the cap, then you can apply to the ATO to have them either consider to disregard that excess contribution, or maybe reallocate it to a new financial year where you have a fresh new concessional cap. Now, the ATO is quite strict on that in terms of whether they allow you to disregard that excess or reallocate it. They, in their view, ignorance of the rules or any administrative errors or any misunderstandings of the law is not seen to be a special circumstance.
Surprise.
Yeah, look, it's really quite strict, and they haven't said what is a special circumstances. Rather, in typical ATO fashion, they've said what is not a special circumstance. So they give you the double negative. So they say, look, if you're suffering financial hardship, then that's not special circumstances. If you think that our determination is unfair, that's not special. If you unintentionally exceeded the cap, that's not a special circumstance. So there's a real limited, scenario or reasons for why, the ATO might consider it, but you can try your luck. But if you're going down that path, then you're not going to, potentially be lucky and get out of this excess contribution. So just really need to be careful about how much you're putting in and stay within those caps.
So the excuse "I don't like it" really won't wash.
Exactly. And even if you got incorrect or incomplete professional advice, the ATO is saying that's not a special circumstance. So
absolutely.
So you've really got to just make sure that you're not making these mistakes and you're not unintentionally, or just because you don't know the rules will not cut it.
So if your advisor or accountant get it wrong, you're still going to get it wrong, and the ATO won't take that into consideration. So look, we're at about half time now. You're on Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I'm really pleased to have at the microphone and camera Natasha Panagis, who is from the Institute of Financial Professionals Australia. We're going to take a short break and we'll be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I'm really pleased to welcome to the microphone again Natasha Panagis, who is from IFPA. If you're wondering, their website is ifpa.com.au, ifpa.com.au, and that is the Tax Agents Association, the Taxpayers Association, that's been around for over 100 years, ladies and gentlemen. So they're no fly-by-nighters. They've been here for a long, long time. And so you've got chartered accountants, you've got CPAs, then you've got IFPA. And so they represent a wide body, probably over 4,000 members, isn't it, Natasha?
Yeah, that's right. And close to 22,000 members and supporters as well.
There we go.
Yeah.
There we go. So no fly-by-nighters, ladies and gents. And the wonderful thing, Natasha is a subject matter expert on matters like superannuation. And today, part one, or the first half of today's show, we've been talking about concessional and non-concessional contributions and what happens if you actually go over your CC cap, your concessional contributions cap, which is your $30,000 per annum. Now, we talked about two options and notifications. So, ladies and gents, Natasha, you explained you'll get a notice from the ATO, won't you?
That's right. You'll get a notice to say, look, you've exceeded the concessional cap. what would you like to do? Would you like to take it out or would you like to leave it in? And depending on what option you choose, there's going to be different tax consequences.
So let's talk about those two options. So you've got the notice from the ATO, and they're now saying, okay, you've exceeded it by, and I think that you've got some examples in the nice cheat sheet you've sent me. But let's talk it through now. So you've got the letter, and you've now got two options. So what are those options that the listeners need to consider?
Yep. So you either take the excess amount out of your fund or you leave it in there. Now, no matter what option you take, whether you actually withdraw the excess or you leave it in your fund, the core tax treatment of that excess concessional is going to be the same. So, but I mentioned before, if you leave it in your fund, that can create some additional problems because it will count towards your non-concessional contribution cap. Now, the tax consequences is going to be that excess concessional contribution amount is going to add towards your assessable income in that financial year that the excess occurs, and then that's going to get taxed at your marginal tax rate. You'll also get a 15% non-refundable tax offset to reflect that tax that has already been paid by your super fund on the amount that went in.
I think that's a very important thing to note as well, ladies and gentlemen. The 30 grand that's gone in and the excess has already had 15% taken out. So that's the 15% tax that applies right across all super. So I think that's a very important point.
Yeah, and because once you put a concessional contribution in or it's been received by your fund, you'll see that 15% tax gets taken away from that. So if you've got an excess concessional, yeah, sure, that excess is going to count towards your assessable income, but because it's already been taxed in the fund, you're going to get this 15% tax offset to acknowledge that tax that's been paid. So that's going to be your tax outcome, right, for exceeding the cap. Mm-hmm. Now, like as an example, let's just say you exceeded your cap, your concessional cap by $2,000 last financial year, the 24-25 financial year. Let's say, you exceeded that because you may have received a bonus from your employer and that extra super guarantee contribution on that bonus amount has tipped you over $30,000. Now, what happens is, you lodge your tax return for the 24-25 year. You then get a excess concessional contribution determination notice from the ATO a few months later. And then that determination is going to tell you that you've exceeded your cap by $2,000. It's going to give you two options and it's going to give you a 60-day time frame to respond. So you've got 60 days to decide what option to take. So your option one is to do nothing and leave the excess in your fund. And as I mentioned, if you leave it in your fund, it's going to count towards your non-concessional cap. This could cause you to breach your non-concessional cap if you've made non-concessional contributions and maximized that cap as well. And if that happens, then the ATO is going to issue an excess non-concessional contribution as well. So really got to tread carefully there and decide what might be the right one. So that's option one. Option two is you decide to release that excess amount from your fund, which is releasing 85% of that excess from your fund. And then that's your second option. So you've got to decide those options and you've got a 60-day time frame to
and remembering, ladies and gents, the reason it's 85% only is because 15% has already been taken and paid in tax. So that's why you can only offload or take out 85%. So I guess with that, you've got these letters. So what happens then? How does this process actually occur?
Yeah, so you've got the letters from the ATO. You've got to make that election, right? And you can make that election. Let's just say you're going to release the excess amount from your fund. Mm-hmm. Then you can do that in one of three ways. You can do that online through MyGov. So if you've got your linked your MyGov account to your ATO online services, then you can complete it's called the Excess Concessional Contributions Election Form. You can do that online. If you haven't got a MyGov yet, then you can obviously register for it and do that online. Or you can ask your tax agent to do it for you using, they will use their own online services for agents portal, so they can do it for you. Or you can do it the old school way using a paper form, and that's if you're unable to do it online or if your tax agent is unable to do it online, you can get the form download it off the ATO's website, and you can do it online. You can do it by paper as well. But I've got to say, the online version is a lot easier. Whichever way you decide to make that election, you've got to lodge it within 60 days of the issue date on the ATO's determination notice. Okay, so you've got to do it within that time frame. And look, you can nominate, if you want to release the excess, you can nominate for that excess to come out of one of your accumulation accounts, or you can choose to withdraw it from a super pension account you might have, or a mix of both. So you actually get to choose where you want to take that excess concessional contribution amount out, or the tax amount out to pay for that tax.
Okay, now I guess the very valid question then becomes: is one option better than the other?
Yeah, look, it really just depends on where you might want to take that amount out from. So, if you have let's just say in your super fund, if you're taking it out from there, then that amount will, when you're withdrawing that excess amount, there's something called the proportioning rule, which means generally when you make a withdrawal from super, or you take a pension payment from your super fund, it's got to be withdrawn in line with your taxable and your tax-free component. That's called the proportioning rule. Right. But when it comes to excess contributions and withdrawing that amount, this proportioning rule doesn't apply, which means that when you're releasing that, it just comes out of the taxable component of your super fund, which can be a good thing, because reducing the taxable component of your super fund means in the end, that taxable component reduces, and it can be quite beneficial for estate planning purposes if you plan to leave your super, say, to some adult kids that you might have, or to somebody else. So there are some great strategies to put in place when deciding which fund to take the excess amount from. What that fund looks like, because every super fund has two components. There's a tax-free component and there's a taxable component. And if you can choose the super fund that has a high taxable component to release the amount from, that's probably going to be the better option, because you're running down your taxable component, and that can have benefits down the track. So worthwhile thinking about what fund makeup, taxable component makeup those funds have. So there's a bit of useful planning involved there, and good idea to preserve the fund that has a higher tax-free component in there, because you want to keep that in place and run down your taxable component. And if you're withdrawing amounts, best to do it from the fund that has a higher taxable component than other funds you might have.
I guess it's really worth mentioning the estate planning elements of super, because I think one of the most startling statistics that I draw when I'm doing reading around self-managed funds and APRA funds is that a vast majority of superannuation never gets spent by the superannuants. They actually pass from the superannuants to their beneficiaries as part of estate planning. And so part of the unintended consequences, and I've had previous guests on here talking about how this system has become the unofficial death tax, because by not spending this money and leaving the non-tax components in super, when someone dies and that money passes on, and remembering super is outside of a normal will, okay, so that money that then passes then has to be treated for tax purposes as well. And so many people that will see super coming to them through an estate or a will, all of a sudden find that comes with a tax bill as well. Excuse me. And so, Natasha, you make a very good point that there are a couple of options there, but it's absolutely worthwhile talking through with your tax agent or your financial planner what those impacts may be. Now, just in rounding out, I always like to leave the audience with some key takeaways. You've mentioned one already, MyGov. I mean, you said, some people don't have I can't imagine anybody not having a MyGov account. I don't know how you would operate in today's society without one, but that notwithstanding, that's an excellent resource, because you can then see what your super balance is, what your CC cap is, and what your NCC contributions have been. What other kind of resources do you recommend our listeners go and have a look at?
Yeah, so MyGov's good. You can also log on to your super fund online member account. Like if you're part of a large APRA fund or a retail fund, you can log online and see what your super balance is as well. And you can look at your contribution history as well. So that could be a nice marry up to MyGov. So you can do that. But if you've got your own self-managed super fund, things are a little bit more different. The details might not be up to date in MyGov. So that's when you might want to instead speak to your accountant or tax agent to give you the information, or your SMSF administrator if you've got one. So certainly check your super statements and account balances online as well. But look, in rounding up the key takeaways of concessional contributions and excess contributions, for many clients, option 2, which is releasing the excess, is going to generally provide you with a better strategic outcome, but particularly because when that released amount comes out of your fund, you then have a choice of, do I want to put that back into super? And if so, you could potentially put it in as a non-concessional contribution. So although you put it in initially as a concessional, when you release it, you can still put it back in, but put it back in as a non-concessional. That will go in as a tax-free component and preserve your non-concessional cap space by not keeping it in the fund and not having it count towards your non-concessional cap if it's an excess concessional contribution.
So it's like a little mini recontribution strategy.
Exactly. And look, it can improve estate planning flexibility. It can reduce your tax and potentially reduce future death benefits as well. But in some cases, it might be worthwhile to leave the excess in the fund, especially if you are ineligible to make any further contributions into super. Let's say you might be over 75 and you've accidentally exceeded the concessional cap. Once you reach 75, you can't make any additional non-concessional contributions. So if that applies to you, you might want to leave it in the fund. Or, you might want to leave it in the fund if you haven't made any non-concessional contributions and you have a non-concessional cap to play with. It really just depends on your circumstances. And this is where I'd highly recommend you chat to a professional about which option is better. So it's not the end of the world if you exceed the cap. There are options, but it's just worthwhile knowing what those options are and what's the best one for your case.
Wonderful. We're out of time, Natasha. Time always flies when we're chatting about wonderful things like super and concessional contribution caps. We're going to come back to talk to you about part 2 of this around the NCC area. Natasha Panagist from the Institute of Financial Professionals of Australia, thanks so kindly for being on Dollars and Making Sense.
Frank, talk to you again soon.